Omar, it's been tough. We all know that. Do you see the investing conditions and monetary policy easing at some point soon?
Easing, I don't think so, with probably the only exception being China. But outside of China, I think monetary policy is really behind the curve. I said that in your show last time, or with Haslinda, back in January, and I think that, for instance, for the Fed, they were really itching to go with 50 basis points, and I think the Russian invasion of Ukraine stopped that, so they went for 25 basis points. I think for the next 1, 2, potentially 3 meetings, they might do 50 basis points if they can. So I think in terms of monetary policy, it's globally behind the curve. And I think what you will see and what you are starting to see, Bank of Canada, New Zealand, today with the MAS, Bank of Korea, is that there's going to be more of synchronized hikes all over.
All right. And against the backdrop of that, markets do look ahead. Is there any value right now in fixed income, and where would that be?
Within fixed income, I think there's a few things that are interesting, but I think broadly, what we are telling our investors is it's very important to be duration hedged. I think in terms, particularly when it comes to the treasuries, I think a case can be made that the bulk of the move is done. It doesn't mean that we're going to see a reversal, but I think we might start to see some stabilization because there's a lot that it's priced in. So duration hedge continue to be important for some time. In terms of our region here, David, in terms of Asia, I think we obviously saw a very strong dollar this start of the year, and there was a perfect confluence of factors: risk sentiment deteriorating, interest rate differential, US being a bit more insulated, so economic growth still strong. But I think we're going to start to see some pockets of value within certain local currencies, for instance, Thai baht. Within the hard currency market, the investment grade market continues to be relatively well anchored and frankly outperforming most of its peers. High yield, it's really very idiosyncratic stories, very specific. I think part of that market, particularly in terms of China property, that market is scarred, and I think part of it will simply not come back. But there are certain names and we're starting to see some returns dispersion there, which is quite healthy. We think that there are certain names that have a lot of value and that are going to survive the current turmoil.
And do you think, on that last note that you just made on Chinese high yield, that the coming and probably imminent really policy support, in what form we don't know yet, do you think the market's priced that in already?
Yeah, I think the key term in terms of what you said is we don't know yet. And this is a problem that we've had for some time, which is essentially in terms of policy announcements and the narrative, it has been supportive, but we have not really seen any major tangible actions. So I think now with the lockdowns or quasi-lockdowns that we're seeing in certain tier 1 cities, which is really significant and represent major downside economic risks for China, I think they will probably step up their policy support, and that's going to come through monetary policy. And I do take the point that monetary policy might not be effective if we have lockdowns, and obviously that will stifle demand and supply. But still, it will be incrementally beneficial. And I think what they'll do is that they will have a larger credit impulse, so they will be creating credit, and this is something that we're starting to see. And I think probably the fastest way will be to relax some real estate related measures, but we don't expect big bang announcements. We think that it will be relatively more incremental and gradual, but I think there is some kind of inflection point that we might be getting to because of the downside risks driven by the COVID-0 policy.